Learning Objective 4 is to prepare an income statement including the calculation of cost of goods sold. The merchandising companies calculate cost of goods sold as beginning merchandise inventory plus purchases minus ending inventory. So beginning inventory plus purchases gives us goods available for sale. Then we deduct ending inventory to calculate our costs of goods sold. For manufacturing companies, the cost of goods sold for a period is not simply the manufacturing cost incurred during the period. They calculate cost of goods sold as beginning finished goods inventory plus the cost of goods manufactured. And for a manufacturing company, some cost of goods sold may be units completed in previous period, and some may be the units completed in the current period that just have not been sold yet, and they'll still be sitting on the balance sheet as an asset. So our cost of goods sold is computed with the aid of a schedule of costs of goods manufactured, which takes into account our beginning and ending inventories. While this cost of goods manufactured schedule is not normally included in our external financial reports, we'll look a little bit further at it later on when we have to prepare a cost of goods manufactured later in this chapter. But for now, for our manufacturing company, we'll have beginning finished goods inventory plus cost of goods manufactured gives us goods available for sale. Then we deduct our ending finished goods inventory to arrive at our cost of goods sold. So really the only difference between our merchandising company and our manufacturing company is that with the merchandising company, we purchase inventory from an external supplier, while with a manufacturing company, we manufacture the goods ourselves. The computation of cost of goods sold relies on this basic equation for inventory accounts. Beginning inventory plus purchases or additions to inventory must equal our ending inventory plus any withdrawals from inventory, which in the case of a retailer would have been our cost of goods sold. In other words, whatever was present in beginning inventory plus purchases or additions must equal whatever was sold and any leftover or ending inventory balance. If our beginning balance of inventory at the beginning of the month was $1,000 and we purchased $100 of inventory during the month and sold $300, what would our ending balance be? Our ending balance would be $800. We take our beginning balance of $1,000 plus purchases gives us $1,100. The $1,100 needs to be spread between ending inventory and anything we sold. Let's go ahead and prepare an income statement for a merchandising company. Last month, Cyber Games, a computer retailer, had sales of $1,450,000, selling expenses of $210,000, and administrative expenses of $180,000. The company had beginning merchandise inventory of $240,000, purchased additional inventory for $950,000, and had ending merchandise inventory of $170,000. Prepare an income statement. Our first step is to calculate our cost of goods sold. We'll take our beginning inventory of $240,000 and add that to our purchases to get goods available for sale of $1,190,000. Our cost of goods sold then is simply our goods available of $1,190,000 minus our ending finished goods inventory of $170,000. Our cost of goods sold then is $1,020,000. Our gross margin or gross profit, recall, then is simply sales of $1,450,000 minus our cost of goods sold of $1,020,000. Our net operating income then is our gross margin of $430,000 minus our selling administrative expenses. Our net operating income is $40,000.